The U.S. China trade conflict has escalated from a tariff dispute to a contest for global supply chain control. Major U.S. retailers, including Macy's, Walmart, Target, Gap, and Apple, are accelerating efforts to reduce reliance on Chinese manufacturing, shifting production to countries like India and Vietnam. Chinese fast fashion brand Shein also plans to expand its supplier base in India to address tariff pressures. These shifts reflect the ongoing reorganization of global supply chains. In recent years, tensions between the United States and China have escalated across technology, trade, and national security sectors. The U.S. government is urging companies to lessen their dependence on Chinese supply chains. Apple is also facing mounting pressure to decouple from China. Apple CEO Tim Cook stated in May's earnings call that most iPhones sold in the U.S. will be produced in India during the June quarter. Nearly all iPads, Macs, Apple Watches, and AirPods sold in the U.S. will be manufactured in Vietnam. Bloomberg reports that Wang Lai-chun, chairman of Luxshare Precision, a major Apple supplier, said in early May's earnings call that products exported to the U.S. have not been made in China since the trade war started in 2018. Consulting reports indicate Apple began shifting its electronics manufacturing in 2018, likely due to U.S. tariffs on Chinese goods. Before 2018, about 60 to 70% of electronics manufacturing was based in China, covering nearly all final assembly of key devices like the iPhone. Currently, about 50% of Apple's factories are in China, with increasing shares in India and Southeast Asia. Of the 17 companies in Apple's supply chain handling electronics manufacturing, only 2 are Chinese. Of the 34 reported electronics manufacturing plants in China, only 3 are operated by Chinese firms. Apple's accelerated production shift suggests the tech giant expects the trade war's impact to persist. Apple once supported numerous Chinese workers and businesses, but that era is nearing its end. As production moves, China's electronics manufacturing sector may face reduced orders and job losses. Apple's production shift stems from multiple factors: trade war tariffs, geopolitical pressures, cost optimization, the need for supply chain diversification, and the appeal of emerging markets. The U.S. China trade conflict has escalated from tariffs to a contest for supply chain control, prompting U.S. retail giants to accelerate efforts to reduce reliance on China. On May 28th, Macy CEO Tony Spring stated in an earnings call that about 20% of the company's products are sourced from China. National brands, which drive most sales, source 18% from China, while 27% of private label products come from there. Spring noted that Macy's is diversifying its product sourcing. Last year, China accounted for about 32% of products, down from over 50% before the pandemic. Gap CEO Richard Dixon said in a meeting that, although China was once a key supplier, its share dropped to under 10% last year. He expects this to fall below 3% by the end of the fiscal year 2025. Gap plans to boost U.S. cotton sourcing, indicating some reshoring. Dixon said last year Vietnam and Indonesia accounted for 27% and 19% of sourcing, respectively. The goal is to keep any single country's share below 25% by the end of 2026 and double U.S. cotton purchases by 2026. Target's business director, Rick Gomez, stated that in 2017, about 60% of Target's products came from China, a figure now at 30%. He noted, "We expect to reduce this to below 25% by the end of next year." Gomez said Target's top-tier global sourcing team, diverse products, and strong supplier partnerships enhance business flexibility to address tariff changes. Walmart CEO Doug McMillon stated in May's earnings call that nearly 2/3 of Walmart's procurement spending supports U.S.-made products, with the remaining third sourced globally, primarily from China and Mexico. Walmart, the largest U.S. private employer, has repeatedly cautioned that tariffs may lead to price increases. In April, the U.S. applied a 145% tariff on Chinese goods, later reduced to 30% for about 90 days, following a temporary agreement with Beijing. Walmart initially tried to shift tariff costs to Chinese suppliers, but met strong resistance, prompting the U.S. retailer to accelerate supply chain diversification to reduce reliance on China. A source from a Zhejiang-based stationery manufacturer recently told Chinese media that they are discussing contingency plans with U.S. retailers like Walmart for after the tariff truce. Under a prior deal with a stationery manufacturer, Walmart agreed to cover all tariff costs until August, but no orders have been placed for after August. The source said that they can absorb up to 30% of additional tariff costs, but absolutely cannot handle 50% or more. Smaller suppliers struggle to cover extra costs, managing only up to 30%, while larger ones adapt by establishing factories in Vietnam and India. No agreement has been reached with Walmart. With tariff policies uncertain and geopolitical risks rising, global companies continue shifting supply chains out of China. Beyond U.S. retail giants, Chinese online fast fashion retailer Shein plans to move its supply chain outside of China. France's RFI reported on June 9 that Shein plans to rapidly expand its supplier base in India, aiming to start selling Shein-branded clothing made in India within 6 to 12 months. Analysts note that, in response to new U.S. tariff measures, Shein is adjusting its production lines and strategies, expanding quickly in places like India and intensifying competition in the global fashion industry. Shein, headquartered in Singapore, began preparing for U.S. tariffs on Chinese imports by negotiating with Indian retailers, enhancing the diversification of its clothing supply sources. Recent reports show Shein aims to grow its supplier base in India from 150 to 1,000 within a year and continue expanding its international market. Shein's fast fashion model offers low-priced clothing such as $5 dresses and $10 jeans, sourced from 7,000 suppliers in China and shipped directly to customers in about 150 countries, with the U.S. as its primary market. The company is adapting to new tariffs on low-value Chinese goods imposed by the Trump administration, which were previously exempt from U.S. import duties. Shein entered the Indian market in 2018 but was banned in 2020 due to border tensions between China and India, prompting India to sanction companies linked to China. The landscape has shifted, and Shein reached an agreement with India's Reliance Industries, re-entering the Indian market in February this year and starting to sell locally produced clothing. Bloomberg reported, citing sources, that Shein's plan to shift some production out of China faced resistance from the Chinese government. Amid the escalating U.S. tariffs under the Trump administration, Chinese authorities are working to curb manufacturing outflows. Shein's expansion in India aligns with a trend of U.S. retailers like Walmart turning to India for sourcing. Many U.S. companies are pursuing new supply markets outside China to navigate the U.S. China trade war. Beyond trade friction and geopolitical factors, rising domestic labor costs have pushed many of Shein's suppliers to reorganize a sharp shift in industry conditions, moving production to Southeast Asia. Industry insiders suggest Shein's relocation of clothing factories may lead to the closure of about 1,500 factories in Guangzhou's Panyu district, leaving over 100,000 workers jobless. In recent years, Shein's fast fashion model, fueled by rapid product updates and low prices, has captured North America and European markets. This approach not only challenges traditional retailers, but also intensifies competition among Chinese sellers. Small and medium-sized sellers, lacking the resources and scale of large platforms, often follow price cuts, facing thin profits or losses. While this pricing strategy may draw consumers short-term, it compresses industry profit margins over time. Additionally, new sellers aiming to gain ground undercut established ones, driving the industry into a harmful cycle. The New York Times reported on May 12 that a factory owner says Shein is offering incentives to Chinese factories to reduce the cost of relocating to Vietnam. An Alibaba e-commerce manager focused on connecting merchants with business partners confirmed the company has sent a team to Vietnam to help firms find alternatives outside China before Vietnam's tariff grace period ends. Jiayue Craft, a Chinese company producing Christmas ribbons, socks, wreaths, and gift bags, has already set up operations in Vietnam. At a trade fair in Ho Chi Minh City, the company's translator, Jack Shu, said that over the past 3 years, more than half of the production has shifted out of China. The company is now weighing further expansion in Vietnam, as most of its clients are in the U.S. He noted, "For most Chinese people, we still aim to sell our products to Americans." On Chinese social media, individuals are sharing tips to bypass trade regulations. For example, a recent Xiaohongshu post explained how to conceal a product's Chinese origin by shipping it to Malaysia or other nearby countries, repackaging it, and then forwarding it to the U.S. China's export growth slowed in May due to the U.S. China trade war, with exports to the U.S. declining further. China's General Administration of Customs reported on June 9 that May 2025 exports reached 2.3 trillion yuan, up 6.3% from last year, while imports fell 2.1% to 1.5 trillion yuan. In dollar terms, exports grew by 4.8%, a drop of 3.3 percentage points from April, and imports declined by 3.4%, widening by 3.2 percentage points from the prior month, marking a third consecutive month of decline. Worsening U.S. China trade relations drove China's weak May trade figures. Due to the lagged effect of tariffs, the early May easing of tensions was not reflected in the latest data, which instead showed continued decline. China's exports to the U.S. fell 34.6% year-on-year in May, deepening the 21% drop from April, the steepest decline since early 2020. China remains the U.S.'s largest maritime import partner, with goods arriving via ports like the busy Los Angeles Long Beach complex. Descartes data show U.S. container imports from China dropped to 630,000 TEUs in May 2025, down 20.8% from April's 800,000 TEUs and 28.5% year-on-year. China's share of U.S. container imports also fell to 29.3% in May, the lowest in over 2 years. U.S. West Coast ports heavily reliant on Chinese trade felt the impact of the downturn. Descartes noted that imports of Chinese goods at Long Beach and Los Angeles ports dropped 31.6% and 29.9% respectively from April to May. May's decline signals the first notable contraction, driven by tariff fluctuations and rising trade pressures. Xu Tianchen, senior economist at the Economist Intelligence Unit, stated, "Despite the partial removal of high tariffs in mid-May, the damage has already been done. U.S. retail giants like Walmart, Macy's, and Gap, alongside tech leader Apple and even Chinese firm Shein, are shifting production to India, Vietnam, and Indonesia, undermining China's role as the world's factory." The U.S. and China reached a 90-day agreement on May 12 to reduce escalating tariffs on each other's goods, previously exceeding 100%. Officials from both sides met in London on June 9 for a second round of trade talks to ease tensions. The U.S. team, led by Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, and U.S. Trade Representative Jamieson Greer, met with China's delegation, headed by Vice Premier He Lifeng, who also led the prior talks in Switzerland. Sources say the discussions are expected to extend to June 10th. A key focus will be China's rare earth exports, essential for products like electronic vehicle batteries. Rare earths have long fueled tensions. China's export restrictions may drive the U.S. to speed up development of domestic and allied rare earth resources, gradually reducing China's strategic edge. U.S. policies limiting exports of advanced technology, such as high-end chips and aircraft engines, to China may also be a central topic in these talks. China leverages its rare earth dominance as a bargaining tool, seeking U.S. concessions in high-tech sectors. Yet export curbs could push the U.S. to accelerate domestic and allied rare earth development, ultimately eroding China's long-term strategic leverage. The trade negotiations are set to enter their second day. Trump stated, "China is not easy," but also mentioned that the U.S. government has done well and is hearing good news from London. Trump has not committed to lifting export restrictions. When asked about the possibility of lifting them, Trump told reporters, "We're going to see." Trump remarked that China has been exploiting the U.S. for years and also added that they hope China would open up. Trump's June 5th call with Xi Jinping set the stage for the London talks, but no significant agreement has emerged on key issues. Though U.S.-China trade talks have resumed, some experts on U.S.-China relations note that deep structural and geopolitical divides are unlikely to be bridged through negotiations. Scholar Guo Guoming, a Peking University graduate, told overseas media that the London trade talks aim to ease tariff and supply chain tensions. However, geopolitical friction, core high-tech disputes, and the strategic sensitivity of rare earths limit meaningful progress. Long-term, the trend towards strategic decoupling persists. Fu Shenqi, an editorial board member of China Spring, stated that the U.S. is fully preparing for a potential Taiwan Strait conflict. While the trade war may pressure the Chinese Communist Party, it fails to address the core systemic divide. Only by fostering the CCP's collapse and advancing China's democracy can the underlying conflict be resolved.